Are you ready to supercharge your wealth and unlock the power of passive income? Welcome to this episode of Dividend Discussion, where we embark on an enriching journey through the realm of dividend investing. Whether you're a seasoned pro or just starting out, this series is a gateway towards invaluable insights and firsthand experiences that will propel you towards financial independence. Join me as we dive deep into the minds of others in the dividend investing space that are eager to share their stories, mistakes, triumphs, and life-changing lessons. In each episode, we unlock the secrets of successful dividend investing, ensuring you can sidestep costly pitfalls and chart your own path towards financial freedom. Sit back, relax, and immerse yourself in this captivating episode of Dividend Discussion. Hello and welcome to another episode of Dividend Discussion here on Dividend Obsession. My name is Troy, and today I have the pleasure of speaking with Mark Chambers. Mark, go ahead and tell the people a little bit about yourself.
Hey, what's going on, Troy? Thanks for having me. Well, Mark Chambers, I'm 47. I live in the Midwest. Full-time baseball instructor. So I do what I love every day, and wouldn't have it any other way. I love what I do, and I enjoy getting up every day. So
there you go.
But
that's a secret to life right there. You got it.
Oh, absolutely. Yeah. Absolutely.
Nailed it. Okay, so here we go. Diving right in. I need to know when you began your investing journey and then what got you into dividend investing specifically.
Man, I tell you, my how I got into just investing was at a previous job. I worked in car sales for a while, and I had several of my coworkers started to talk a lot about Robinhood. Mm-hmm. And so that piqued my interest about what is this Robinhood thing. So I joined Robinhood, got, my free stock. I think it was, I can't remember what it was. But anyway, so there I started doing all kinds of things. Obviously, you start doing you buy the penny stocks, and, you do the some of the meme stuff, whatever is hot and blah, blah, blah. And I did a lot of different things. I started doing some day trading. I didn't even know what day trading was. And I ended up losing some money. And I decided I was going to study and try to figure out, because I don't like losing money. Mm-hmm. So I got into the options trading quite a bit. Instead of doing day trading, I started doing swing trading, which, I actually got to be pretty successful with that. But what I found out was when you do swing trading, no matter how successful, I found a setup that was very successful for me. It was 92% had a success rate, but you have to follow it to a T for it to remain successful. And what I found out was after, it's very time consuming to study the charts to find out what's good moves. And I started cutting corners on my successful setup, which ultimately made my success rate go down. So I started losing money. But it was really an attempt to try to find a way to grow my money, but not have to be as involved. Because when you're doing swing trading and day trading, you literally have to sit in front of your computer to read the charts and find out, wait for this move. And, it got very, very too involved. Mm-hmm. And so I wanted to look for a more passive approach in order to grow money that I didn't have to spend hours on hours every day sitting in front of a computer trying to figure things out. And so I started looking into other options. I can't remember how I got to find out about dividends, but the dividend. I'm a analytical, so I thrive on information. So once the subject of dividends came up, I just poured myself into researching, what is this dividend? Why is this beneficial? How do I start it? Blah, blah, blah. And my journey started from there.
So what time frame was this? Like when you discovered Robinhood, and then
this was 22. No, excuse me. I started 18 was when I started to just mess around with various different types of investing, the day trading, the swing trading, blah, 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 blah. But around 21 was when I took a hiatus after I lost some money
Yeah.
and started studying more. So 21 was when I kind of came back in and with the idea, okay, dividend investing is probably a safer way to go, and it's less involved.
Yeah. So it was really the so a couple things on that. One, it was really the passive nature of dividend investing, especially with you
Absolutely.
coming from the swing trading and stuff where it was so intense. I mean, with dividend investing, it's not that there's no research, but it's kind of like initial research and then you're done.
Yep,
You
yep, yep.
kind of like, look at
You
all
got
the
to stay
things you
on.
need to
You
look
got to
at.
stay on top of those charts when you're
Yeah.
swing trading. I mean, they change from minute to minute, second to second. I mean, you're looking at the 5 minute charts and the 30 minute charts and the 1 hour
Yeah.
charts, and I mean, you're trying to decipher all this information and figure out when's a good time to get in, when you want to. I mean, it's just a lot. It's
Yeah.
just
I mean, that's kind of the same reason that like a lot of people, myself included, aren't into like crypto is because it's 24 hours a day,
yeah, no,
365 days. I'm just like, that would be like, you just in the middle of sleeping, you get up to use the bathroom in the middle of the night and you check your phone because Bitcoin's still trading. I'm like, that sounds
yep,
like a terrible relationship. I
yep,
don't,
yep, yep. No, I don't want to do that.
yeah. And not to mention, I don't understand like the whole, I don't like you,
And for me, the crypto, it's still speculative in that there's so many different types of crypto, and I obviously there's some big players, but in the long run, you don't know which one is going to be king, which
Mhm.
one is going to be a viable option in the future,
Yep.
because it's still up. Everything's still up in the air
Yeah.
with it.
And just because there's a leader right now doesn't mean it'll be the leader later on.
Absolutely not.
Yeah. So I agree with that. Okay. So you've been basically dividend investing since about 21, you said, right?
Yeah, yeah.
Okay. So in that time, I'm sure you've made some mistakes.
Oh, absolutely.
What is the biggest mistake you've made? And more importantly than the mistake is what lesson did you learn from making that mistake?
So when I started, obviously the dividends is what attracted me. So my whole approach to the building of my portfolio was to try to get the highest yields, because I want more dividends, more
Mhm.
dividends. So I didn't really research the companies that I was investing in. I was just trying to find the highest yields, and so I think I was adding. For the most part, I added a lot of. I started out with a lot of BDCs, a lot of REITs, because those were monthly.
Mhm.
And, I'm thinking monthly is what I want. I want these monthly dividends. So lots of REITs, lots of BDCs. And I threw in I had several different ETFs.
Mhm.
And so after a while, I started really seeing it wasn't accumulating in the way that I thought it should after 6 months, 8 months or so. So I started re-examining and some stuff, and I started to see on some of those BDCs and REITs that the principal was decreasing, although I was still getting dividends. And to me, that didn't make a whole bunch of sense. So it just encouraged me to start deep diving. I joined the dividend investing group on Facebook, and I just started really soaking in a lot of the advice from some of the more seasoned dividend guys there, and learning about evaluations and things, and so the biggest mistake early was chasing yields,
Mhm.
because at the end of the day, what you want your capital to grow, as well as your dividends to grow. And when dividends are growing but capital is decreasing, then that's like defeating the purpose.
Yeah. I often say it's the like the dividend company sleight of hand where they give you like $75 in your left hand just to take $100 from your right hand. And that's a lot of people fall for that. They don't even look at the right hand. They're just like, look at the $75 in my left hand. I'm like, well,
Yep,
I mean, you really lost $25 in that
yep,
deal.
yep,
Like,
yep, absolutely.
so yeah, I
Yep.
agree with that. So, I mean, you kind of touched on this, but I like, what ways has your investing style changed from when you began until now?
Oh, it's pretty drastically. I think I started building my portfolio again 21. I had to take some funds away for a little while, and then really started to consistently build about the latter part of 22. So I've been consistent since about the end of 22. So, but since then, the holdings have changed in my portfolio. Obviously, I've started to understand a little bit more about what I'm trying to accomplish with the dividend portfolio. So the holdings have changed. How I approach my buy day has changed. How I look at my watch list has changed. That is huge, because one of the things that I did early is, once I found out that obviously there's a big difference between the companies that you invest in for dividends, and that the dividend the rate the dividend rate, the return rate, is not as important as the underlying financials behind the company. So I started looking at more deep dive in the company and not paying as much attention to the dividend yield. But I wanted to make sure I was investing into healthy companies, because I want the dividends to grow as well as the capital to grow. Mm-hmm. So I wanted to make sure I was investing in a lot of stronger companies. So I started looking into not only dividend kings and dividend aristocrats, but I started to learn how to use my screener to find good buys, and to add things to my watch list. So I approach things a lot differently. Like now, and I've seen several of your videos, and you and I kind of agree on some things in terms of price not being as important in the long term. Mm-hmm. And I agree with that to an extent. Mm-hmm. The thing that changed with me is how I enter a position, because now I currently have 26 holdings. I have 5 ETFs and 21 individual companies. I'm very meticulous about how I'm creating my portfolio. I want to make sure I'm diversified. So of each of the 11 sectors, I've got a minimum of one holding. The max I've set myself per industry or sector is 3 holdings. Okay. And right now I've got about 5 sectors with 3 holdings, and then I've got so I'm still looking to diversify the other sectors. I'm not rushing, but in doing that, what I've learned is that some of the good companies that I bought early in my journey, they were good companies, but I bought them at the height of, and so what I've been doing with some of those companies, like let me pull up couple of this so I can.
Well, that's where in that video that you're referencing that I did, where I said price doesn't matter, the 2 reasons behind that was fractional shares and then dollar cost averaging.
Yes, absolutely.
So I mean, that's where both of those strategies come into, like, you identified that, okay, whether it was on purpose or on accident, the companies that you identified when you first began that turned out to be good companies that you still want to hold going forward. You might have bought them at an all-time high, and that stinks, but at least you have skin in the game, and you can keep reducing that cost by buying more now.
Absolutely. So I'm still holding those companies, but when I add to my portfolio, I have a very systematic approach to how I deal with my portfolio. And I'm going to pull up one of those good companies that I bought at a bad time. A couple of them, Exxon Mobil and McDonald's. I bought Exxon Mobil during the time when gas prices were soaring, and so now as the demand for gas has come down, so has the price. So my entry, I pay more attention to the P&E. I pay attention to the earnings per share, because when you're looking at those, it's not as important once you've entered as it is once to begin your position.
Yeah.
Because if I get into a position when it's at the peak, then that means going forward I'm buying my price down as opposed to buying my price up, which I know that's still a kind of neither here or there, but I'd rather be buying my price up as opposed to trying to buy it down because it's losing money.
Yeah.
Because it's going down.
Yeah. I mean, mine's kind of the same thing with like NextEra Energy is like my biggest dog right now.
Mhm.
And the like I said, I've said this in dozens of interviews already. Like the best thing you can do, especially in dividend investing, is because it's such a buy and hold long-term thing, is like try to remove as much emotion as you can. And to me, I identified NextEra Energy as a stock that fit my criteria when I bought it. So what I did is I was like, okay, say NextEra Energy used to be, I don't know, $90, and say now it's at $55. Well, if I liked it enough to buy it at $90, as long as it's still the same company doing the same
100%.
thing, I better like it at $55. Like that doesn't make any sense to me. So I just pull the emotions out of it, and I'm not, the FOMO of like, oh, why is it going down, and like worrying about all this stuff. Like to me, I liked it. I identified it as a good company. Now that's the importance of identifying good companies, is because if you just go on a random Facebook group or whatever and listen to Joe Schmo say, oh, I love this stock, and you do none of your own research, and then that stock goes down 10%, you have nothing tying yourself to that stock. And you're
Absolutely
just like, oh,
not.
Joe Schmo was wrong. Investing's a scam. Dividend investing's a scam, whatever. But if you commit yourself to your own research and justify why you need to put your hard-earned dollars into that stock, you already know when it goes down, if it's no big deal, put more money into it and lower that cost basis, like you're saying. So
Absolutely. So I right now I only have, I think, two individual stocks that I had at the beginning of my journey, and those are and I'll share. One is Verizon. Verizon's they seem like they're kind of trying to turn things around, but I'm only down like 1%, so it's not. The dividends have offset my the losses for the most part so far, so I'm not down a lot. So I'm just going to ride Verizon out. But the other one is MPW. I got into MPW, and obviously it's not performed well in the recent months, but based on some of the things that I've seen, and the fact that I've allowed, now that I've become more conscious of allocations. Early MPW occupied way too much of my portfolio. So now that I've managed to concentrate on evenly diversifying my portfolio, I've got the real estate sector to kind of come back down a little bit, because for a while I was really heavy with real estate because I wanted the monthly dividends and and all that stuff. So but MPW, I'm gonna ride it out. But because I'm my approach to buying is very systematic. Obviously, it's lost money. I'm now getting into the place where my real estate holdings are getting to where I might start to need to buy some to keep my allocations in line. So it's going to be a pretty good opportunity for me to do some dollar cost averaging and bring my cost basis down and see what happens moving forward.
So this is not a scripted question, just out of curiosity. Like, how do you, or have you had this situation come up yet where like you evaluate like whether to not add to a position anymore? Like you want to turn it into like more of a dormant position, or like maybe maybe even selling a position? Like how do you cross that bridge?
The only time I plan on selling a position, in the past it was based on the fundamentals, because I had the way I had put together my portfolio beginning wasn't very smart, and so as I started to learn about valuations and how to determine whether companies are good companies or not good companies, I found out that a lot of the stuff that I had invested in early wasn't very good investments. So I before I replaced those, I researched whatever sector it was in, whether it was in the industrial sector or whether it was in the material sector, whatever. If I was going to replace one, I started researching the best stocks in that sector, the best dividend stocks in that sector, so that when I sold a position, I had a replacement. Mm-hmm. So the only time I will sell a position is if I find a better replacement.
Okay. So, yeah, because I mean, I wonder that, like, I think in 2024, I'm going to do like a little bit of changes to like my philosophy, not as far as like making it more complicated, but just as far as like, I've in these interviews, I learn a lot of things myself, which is obviously the goal for anybody watching, but I also get to learn some things too. And one of, I did an interview with Dave a long time ago. He's the guy that was from Australia. And he was talking about like his biggest regrets are always when he sells stock. It was
I don't sell.
Yeah.
It's once I learned how to value stock and determine this is a good long-term hold. And I utilize a lot of your videos. Matter of fact, I've added probably 4 of your suggestions to my portfolio since you've been doing the video. And
is that from the Power 5 stuff?
Yes.
Yeah. That's a fan favorite series. Like, it doesn't take me like, I was actually working on that right before our interview. I was working on this coming week's video, and it doesn't take me terribly long to do, but like, and a lot of like, if I do this video this week and like next quarter, this same week, some of those stocks are the same, like I might end up mentioning the same stock in next quarter's video.
Right.
But like every quarter, those stocks have to back it up. Like, it's not like if your yield goes up or goes down and like you were the yield leader and now there's somebody else coming in with a higher yield, you can easily fall off that list. So it's, absolutely. I think it's kind of, I was thinking about that this morning. I was like, man, like I know I've seen this one before. I know I've seen this one before, but I was like, that's kind of a test to what the point of my video is that these stocks quarter over quarter. Yeah, they're there every time. And that's good. Because it could be like, oh, you're there this quarter, but I've never seen you again. And I'm like, well, is that a good thing or not? Like, it's cool that I got to show you a different stock, but it's also reassuring that like every time Lowe's comes up, they're always on the list. Like, there's a reason for that. So absolutely. Yeah, that was little self plug.
Yeah. There, so yeah, I've added probably 4 of the suggestions. Like I said, and they only come up when I see a suggestion from your videos that piques my interest. I will, do my own research, and if it meets what I'm looking for, then I'll add it to my watch list. Mm-hmm. And then it only comes up if I'm for instance, right now I am probably going to be looking to add one more into the financial sector. So no matter what my watch list holds, the only thing I'm really concerning myself, okay, what are the best performing in the financial sectors? Are these in a good buy position? So now I want to make sure that when I enter a new position, I make sure I don't enter when it's on the high. I enter at a good time where I can reap the benefits on the way back up.
Yep. Yeah, and I think the video at the time of us recording this, I think the one I just released on Friday, the stock that was at the highest percentage off the 52-week high was actually, I think, GCBC, and that was in the financial sector. So, and like I'm saying, I'm not saying any of these stocks or all of these stocks are good for any one person, but that's the point of the Power 5 is just like, here's a wide variety of high quality stocks, and in theory, each and every person values one or more of those categories.
Absolutely.
Whether you're a yield investor, but like the thing that I try to balance is like helping the yield investors, but helping them with higher quality yield stocks versus like, oh yeah, here's a stock that gives you 13% yield, but it's garbage. Like you would have 10 grand would have turned into 5 grand. Like that doesn't help anybody. So,
and I think that's the fascination, especially early, because once you get the dividend bug, it's okay. Now I need more dividends. Mm-hmm. Now I need more dividends. But one of the things that I learned from you particularly was about the time horizon and the fact that, if you're not going to be spending the dividend, then the dividend return right now is not as important.
Mm-hmm. Would you rather have a like $100 every month now when you don't need it, or $1,000 every month when you do? Like,
Absolutely.
that's what it comes down to. Like, well, I don't care. Yeah, it's cool. It sounds cool that you can go to work or wherever and be like, yeah, I made $100 this month while I was doing nothing. That's great. But like when you actually are done working and you need the money to live off of, that's what it matters.
Yep. And so that and going back to some of my I guess changes or lessons, that is that one thing to focus on, making sure I'm getting capital appreciation in addition to that dividend growth. Because without that capital appreciation, if you get capital appreciation over the long term, when you need to get dividend, now you can convert that capital into dividend paying companies.
Yep.
But you have to get the accumulation first.
Yep. Yeah. And instead of like, you putting 10 grand of your own money into a high yielding asset, why don't you take 100 grand of which 10 was yours and 90 grand was just the company appreciating. And now you can put that same 100 grand in that high yielding company and get significantly more. Like, why would you not do that? So, and like, that's one of the strategies that could, like, when I first started my strategy, that's what I was thinking my portfolio was going to do. I was just going to build it up with my stocks at the time I need the money. If I'm just like, 50, I'm done no matter what, then I can sell those stocks and put them into higher yielders, and there I go. I'm good to go. Best case scenario is that the stocks that you bought that got you there, you can keep riding those because the dividend income is sufficient. You don't even need to sell. That's best case scenario. And like, that's one of the things that is a perk with dividend investing that isn't available with growth investing. Is growth investing, there's no option because you're not getting income from that stock anyway.
Absolutely. You have to sell. And to reap the benefits, you have to sell the stock.
Yep. And that's a taxable event and all kinds. I mean, yeah, if you hold it for over a year, it's different tax rates and stuff like that, but it is something, there's no other option. I mean, I guess you could technically write options or whatever on those, but like, that's just like, again, the dividend investing is the more passive way of doing all of that. Like, you don't need to write options on anything. You just sit back and every quarter, every month, whatever it is, you just collect money. Why would you not do that? So, okay. So, I mean, you did a really good segue there. So like, do you want to tell us any of your short-term goals? So any goals that you plan to accomplish within like the next 6 to 12 months? And then what are your long-term goals with dividend investing?
So really my short-term goal, I've got a relatively small account in comparison to, others who've been doing it a little while. And, right now my immediate short-term goal is to get to $1 a day.
Yep.
$1 a day. I'm at 72 cents.
Yep.
But $1, that's my immediate goal.
Yep.
Long term really is more about, trying to create a legacy, just to leave something, to just leave something to my daughter, leave something to help others when I'm gone. That's pretty much it. To create some type of generational type of income that I can pass on to people that come behind me.
Yeah, that's admirable to say the least. So, how old is your daughter? If you don't mind.
My daughter is 20. Yeah, okay. She just 20. Yeah.
So does she have any interest? Like, have you showed her like some of the stuff of like, hey, if you do this now, you could be done working by
not yet. We haven't had that conversation. Yeah. We haven't had that conversation.
Hey, that's gonna be like I have my son just turned 10 months old, and obviously he doesn't know what the heck I'm talking about. But like I have him a little portfolio, and like anytime he gets money for Christmas, his birthday, whatever he's gonna get, we're gonna put that in there. The tax returns that we get, that me and my wife get, the money that we get as the difference of like, having a kid now is what we're going to put in there. So if it's $1,000 a year, we're going to put that $1,000 in. He's already on my credit card. So by the time he's 18, he's going to have 18 years worth of credit card history. Cause literally the day I got his, social security card, I called Capital One and said, hey, am I able to put my son on here? And they were like, does he have a social security number? I was like, yes. And they were like, cool. So
that's awesome.
Yeah. Fidelity wouldn't let me do it. They said one person said you had to be 13. One person said you had to be 16. I was like, okay, let me try my other one. So Capital One does let you do it. Fun fact. But, so I did that. So yeah, it's just cool. Like, there's different videos and I'm going to probably do more of these, later on. I just have to figure out when I can do them on like just trying to show someone that is younger, like, 16, 18, 20, whatever they might be, the difference between putting $50 in now a month, just $50, like literally just go to Chipotle 2 less times or whatever it might be.
And that's the crazy thing. Like I told you, I wish I would have did this 20 years ago. There was a guy that went to my church, an older fella. He was a retired teacher, and I mean, almost on a regular basis, once a month, it seems like he would corner me at church, and man, I need to start talking to you about investing, man. I need to get you into. And oh man, I don't want to talk about that stuff. And I'm kicking myself in the butt now, because now I done got the bug, and I'm like, man, if I would have did this 20 years ago when the old guy was trying to get me all started, man, I'd be in a good position right now.
Yeah. So I mean, and I've seen those charts of, and it's never too late. That's one of the important takeaways here. But there's so many charts out there that's like, if you put $50 in a month starting at 20, you're gonna have whatever 1 point something something, 2 point something something $million, which is cool, obviously. But then they're like, okay, in order to get that same $2 something million, how much would you have to put in per month at 25? And how much would you have to put in at 30 and 35 and 40 and stuff like that? So like, that's going to be kind of one of the ideas for the videos I have, is just like showing you, in order to get the same outcome, changing 0 things, getting the same returns, the same dividends, all kinds of stuff, getting the same exact stuff, how much extra you need to put in per month just to make up for lost time.
Right.
And like, that's not to like discourage anybody that, started late, or because I started at like 25, and like, I'm kicking myself that I didn't start at 18. So, I mean, everybody wishes they started earlier, except for the guy that, the interview that's going to be coming out tomorrow with JR Dividends. This dude started at 15, and I'm like, dude, like, you're one of the only people that doesn't have that excuse. Like you did it.
Yeah.
Like, you're doing good.
Yeah. The other thing, one of my motivations is to when I got started, and it's kind of evolved, I guess. But as I've talked to more people, and more people have kind of, well, I don't got time, or I don't have enough money to do that. One of my motivations is to show people that you don't have to have a lot of money to invest. You don't. It's $10 here, $15. I mean, whatever you can, but you never earn anything if you don't get started.
Yep. Yeah. And I mean, like, me and you were, I don't know if it was during the interview or right before the interview, when we were talking about, like the life progression of a dividend investor, where like, you make your first 16 cents and nobody seems to bat an eye, then you make your next dollar or whatever. And like, even your goal, like I hit that goal, and it was cool. Like the $1 a day, $365 a year. Like you say that and somebody's like, oh, cool, I make like $50,000 a year. Let me know what you're gonna do with your 365. But like, they're working and having to get up and answer to a boss and doing all these things. I'm doing nothing, also known as making money while I sleep. And that's just the start. And nobody might care about your $1 a day. You do, obviously, and like other people in the space do. But then when that turns into $3 a day and $5 a day and $10 a day, then people are like, wait a minute, you're making $10 a day for doing nothing? You're like, yeah, see, I've been telling you. And then, so it's one of those things.
And I think that's with anything. There's a saying that says the proof is in the pudding. So there's a lot of people who won't be encouraged and motivated to do something until they see somebody else having success with it.
Yeah. I mean, I've said the same thing several times about like the YouTube channel. Is like, the weird thing about like my portfolio recaps is they don't get clicks unless I put the portfolio value in there. So I've started doing that. And then the thing that stinks is, like, I remember when I first started watching dividend investors, one of the first ones I watched on YouTube was Andre Jick. And he used to talk about his dividend portfolio all the time. And now he doesn't as much. And it was cool because, like, you get this, like, people are naturally attracted to the bigger portfolios because they make more in dividends, but then they're less relatable because it's like, okay, you're making,
how did you get there? You probably had grandma give you.
Exactly. You're like, oh yeah, it's cool that you're making $10,000 a month, but like you have $1 million portfolio, like I'll never get there or whatever. So then you have people like me that'll start recording, or even before what I did, and they'll start showing you like, hey, I'm starting this portfolio at 0. But nobody gives 3 craps about the dude that's got $15
with
in
0, right?
So it's a weird, like, there's no bridge there. Like, either you have a big portfolio and get all the views, but then people say it's unrelatable, or you do a relatable portfolio, but nobody cares because nobody cares about the 6 cents you just made from ExxonMobil. Nobody cares.
Right.
I don't know. It's one of those things. So I actually have remind me at the end of the interview. I'll do it off camera just so nobody steals my idea. But like I have an idea for the beginning of 2024 that I want to do a series on. So remind me about that. Okay, so next question. In your time investing, I know you said you don't sell now, but you did sell before. So do you have any stocks that you regret selling, and then any stocks that you bought and you're just like super happy you did and it's, you know, killing it for you?
Regrets. I don't know. You know, I don't know if I have any big regrets. Not with dividend investing. I mean, I have some regrets when I was doing swing trading and stuff like that. But you know, that's you know, that's in the past, and I was a learning experience, and you know, but I shouldn't have been trading to begin with, because I had I didn't know what I was doing.
Yeah.
You know,
You had some beginner's luck and thought you knew what you're doing.
Yeah, man. And so, what was it? Ask me
Yeah.
the
So
question
selling regrets and buying brags.
again. Okay. So one regret was, I will say one regret was one of the early additions to my portfolio before I knew anything about valuations and before I knew anything about buying good companies. One of the early ads was Broadcom, AVGO. And so when I learned that I had no clue what I was doing about dividend investing, and I wanted to start to redo my portfolio, it was one I got rid of.
Yep. I'm the same way with CDW is one of mine. I identified that with some weird strategy that I had when I first started, and it turns out to be a really good one. It was literally on the video. I don't know if it's one of the winners, but it was on the video that I'm recording today for one of the Power Fives, and I'm just like, the freaking 10-year returns on it are like $100 grand. Like,
unbelievable.
I mean, like, what the heck? Why did I get rid of it?
And so I actually bought back in. It was I only have two in the IT sector, Microsoft and Broadcom. Those are the only two I have there.
Pretty good stocks.
Yeah, I think I'll be good with those.
Yeah, that's pretty good.
And so, but I ended up getting back in, but I missed. Because I got out. I think it was August or September of 22. So it was prior to the big run up they had at the beginning of this year. So I missed out on all of that stuff.
Yeah,
man.
Yeah, that does stink. But do you have any stocks on the other side of that? You know, that stocks that you did buy, even if it was on an accident, you bought it and you're like, oh, okay, and I don't know what I'm doing, but this is $50 and now it's worth 200.
NVO.
What is that?
No, it's in the medical sector. Okay. It's Novo Nordisk.
Oh, okay. Yeah, they have that new weight loss drug.
Yeah. And so when I bought it because I saw the chart. I looked at the chart and I was like, wow, this chart is for the last 5-10 years, all it's been doing. This is before learning about valuations, and I just saw the chart. I'm like, wow, this thing's been just going straight up. Yeah. So I've nibbled at it and jumped in and got a little bit of it. And then as I started learning about valuations and started to get better at recognizing good companies and things, I was like, what? And you know, during this time, I'm watching, you know, this go up and up, and I'm like, well, maybe I made a big choice. So then after I learned how to look deeper into companies and find out whether companies are good companies or not, I was like, well, I made a good choice on this one. I'm gonna hang on to
well, so that kind of touches on something that I don't think I've talked about in an interview yet, but like there is a delicate balance between knowing, like I like information just like you do, but I call it like informational paralysis, where like you look into so many things and you'll get, you know, analysts or something that, or 7 different signs that point towards this being a good stock, and then 10 different signs pointing towards it being a bad stock. And you're just like, all right, well, like these guys made good arguments for this side and these guys made good, like who you don't even know. And then same thing with going back to that video where I said stock price doesn't matter. It could be beginner's luck that you picked that stock, but it could also be that you just didn't have emotion on that stock. You made your choice off of simple things, such as the stock price seems to be going the way I want it to go. And you bought it regardless of the price. And now, like, imagine if you knew what you know now, then maybe you were like, well, I don't really know, you know, the PE ratio is not right, and I don't want to buy it, and you never bought it, and you missed out on all those gains. Mm-hmm. So that's kind of one of the reasons I made that video, because in our Facebook group, I've seen so many people that are like, oh yeah, I've never got to own Apple or Microsoft or Visa or AVGO or whatever, because they were waiting for a certain price that it never hit. And I'm like, would you not rather like own 5 shares of it instead of 50 shares of it, but your 5 shares went up by 10,000%, or never own it at all? Like what? Like
that's how I got into Microsoft.
Mhm.
When I bought into Microsoft, I all I've known my whole life is just Microsoft is a booming company.
Yep.
And so I was, and I kept seeing the same thing that you saw. Well, the valuation is super high, it's overpriced, blah blah blah, it's at an all-time high. And I kept thinking, man, it's always at an all-time high.
Yeah. Exactly.
It's always at an all-time high.
Yep.
So I might as well just go ahead and nibble in now and just keep buying a little bit here or there.
Yep.
And so that's what I did.
Yeah.
And,
I mean, I've done the same thing. Yeah, Microsoft with me. Apple's the same way. Costco's my newest position. Costco is never a good value. Never, ever, ever. But it always produces. So like it's one of those things. They got the membership and the membership to get into the club. Like they do well. They open new stores, like all kinds of stuff, or new warehouses. So it's just one of those things. Like I said, I didn't do that video for clickbait or nothing else. Like I genuinely believe that. Like if you follow along with my portfolio recaps every month, like I try to buy like every day of the month. Some days I forget or get busy, or, like right now I'm doing a OneDrive sync, which is taking way longer than it should have. So I don't have access to all of my documents on my computer. So I wasn't able to buy on Friday. I think I remembered on Thursday, but I think I forgot on Wednesday, like one of those kind of things.
You must have a lot of files you're trying to.
Well, I have all the freaking videos that
your videos.
Yeah, so it's like, okay, this video is 36 gigs. I'm like, well, there's that.
Yeah,
so it takes I started it like yesterday afternoon and it's still uploading.
It's
like 460 gigs or something like that.
So.
Yeah, so it's annoying. But anyway, okay. So you spoke about this before with your $1 a day. But specifically on that topic, what role do dividend milestones and achievements like that help, or what role do they play in keeping you motivated in this long game that we call dividend investing?
Oh, they're everything.
Yeah.
Everything. One of the things that, there's nothing more motivating than, like, I buy typically either on Wednesday or Friday. It just depends on how things fall for the week. But usually on Wednesday or Friday, I have a pretty systematic approach to how I approach buy days. There's no emotion to it. It's based on how my portfolio is lined up and where I need to add capital on that particular day. Because I'm trying to make sure that my portfolio. One of the things that I didn't do early was have even diversification, and that's why when one sector would have a downturn, it would drastically affect my portfolio because I was too heavy or wasn't heavy enough in some other sectors. So I have a really systematic approach. One, I want to make sure I stay perfectly diversified. Like I saw one of your videos last week, and there was a gentleman talking about how something is at a good buy right now, but because that allocation is heavy right now, he's not going. And that's how I am. Although there are a few things that are at a good buy price right now, that sector right now is still too heavy in my portfolio. So if they're still at a good buy when that sector gets to the buy area, then I'll buy. But I want to stick to make sure my portfolio is evenly diversified so that one sector does not impact my portfolio overall too drastically. Mm-hmm. So my approach is simple. I have 26 holdings, 21 individual companies, 5 ETFs. On buy days, I simply do this, and it takes me about 5 or 6 minutes. I write down. I go in my brokerage, and I write down every holding that is under allocated, under my preset allocation. And it usually ends up with being 10 or 12. It takes again, and then I cross out the half of the ones that are closest to the portfolio allocation. So now I've got, instead of 16 stocks I'm looking for, or 10 stocks I'm looking to invest in now I got 5. And of those 5, I pick the one that's the farthest away from its allocation and the one that has the lowest P/E, and I'm done.
There you go. So you only invest in 2 per week?
Yep.
Okay. So what do you do with your ETFs?
ETFs. So because of their allocations, I just follow the allocations. When that allocation comes up, if like my heaviest allocated ETF is SCHD, which I mean it's a favorite of many. So when it's below the allocation and it gets to the area where I need, I'll just go ahead and buy it once it comes under the allocation, so I can get it back over the allocation. And then when it comes back up again, it's just my thing is just trying to make sure my portfolio stays evenly allocated, because it makes it easier for me as I go to my buy process takes literally like 5 minutes. Once I see where I want to put my money for the day, I make the purchases and then I'm done.
So those, is that your like number one, like how do you track that in terms of the like the achievements and milestones? Like how does that
I've got several things I use to track. I've got a pretty extensive portfolio what do you call them? Portfolio tracker on Excel. It has my current holdings. It holds my watch list. It shows me, I mean, countless different metrics and lots of tons of information that helps me. I've got a couple of apps that I follow that I loaded up my portfolio that gives me the allocations, current allocations and things. So I got a couple of different things that I use to gather information to keep me on track. My Excel spreadsheet is probably the main thing. Yeah. I got so much information on there, it's unreal. Yeah. And obviously I'm not adding new holdings regularly. It only comes up, like I said, the next one I'll probably end up adding to was I forgot what it was.
Do you know what your most recent buy was?
What's that?
Do you know what your most recent buy was?
Yeah, I can tell you. I believe it was one of the ones I just added. UFPI.
Okay, that's one I talked about, right?
Yep.
Yeah.
Yep. UFPI, my industrials was low. UFPI has been at a good valuation. And so I added it. And here's the interesting thing. As I've been concentrating more on buying at good prices, like I said, a holding may be in my portfolio, but if it's not at a good buy valuation on buy day, then I buy whatever in that sector that is at a good valuation. But as I've concentrated more on buying at good prices, the interesting thing has happened. The more of the newer additions to my portfolio have been performing much better than the ones that I added at the 6-8 months ago, or maybe even a year ago, because I didn't buy those based on their P&Es and where their current valuations metrics showed. I just bought those based on, okay, this is a good company, and so I bought them at high prices. So now, as I've concentrated on getting good entry prices, the newer additions to my portfolio seem to be performing better than the ones that have been in my portfolio longer.
Yeah. That could also have an impact, just like the market over the past, 2-3 months has just
it's been
so, anything that you had capital in seems to have lost money. So like just because like this is new money, it could be like, oh, okay, well that's why these are doing so.
It very, very well could be. It's probably some of both.
It definitely, because like I said, I don't want to pretend that like somebody that does do a deep dive, and I'm talking like you used to do for swing trading. Some people do that for dividend stocks, where they dive into the charts and look at all kinds of stuff like that.
Is not real deep. What I look for when I look to find out if this is a company, one of the first things I look at, okay, since I'm a dividend investor, let me see what their dividends look like. Mm-hmm. I go, okay, let me check out their dividend history. Okay, because one of the things that would motivate me to add them to my portfolio is obviously their history of dividends. Are they a good? So if they don't have a good history, then I can't say I don't stop. I stop looking. I'll look a little bit more just in case. So I look at the dividends. Then I want to look at um, uh, their stock chart to see, okay, are they, how has their 5 and 10 year history been looking? Have they been going up and down? Is it real big peaks and valleys, or is it kind of just a steady little, or is it just, so I want to look at what their history is looking like. And once I kind of get an idea of that, then I start to look a little bit deeper into their P&E, their CAGR, their and some look a little bit deeper. I just want to look at, okay, are they growing? Are they at a good buy rate right now? If it's a new holding, are they paying dividends regularly? And if those things are there, and they're at a good, I mean, why not?
So I'm curious, when you said that you like the dividends is like the first thing you look at. Now that there's a lot of different metrics on the dividends. So like when you look at their history, are you looking at like they've been paying for a long time, or they've been paying and
I look
growing
at
for a
all
long
of it.
time?
I look at their growth rate. I look at their what is uh, their obviously their consecutive years of growth compared to the sector.
Mm-hmm.
Are they doing well compared to their sector, or are they underperforming everything else in their sector? Obviously, because we want a strong company is going to be doing pretty good when you compare it to other companies in their sector.
Mm-hmm.
That's why you want them.
Yeah.
So I want to see how they comparing to their other counterparts in price appreciation, as well as their dividend growth, and that stuff. So I look at a lot of things in terms of dividends, not just the history.
You would probably be one of the people that appreciates the one of the old series I did the most. I don't know how long you've been subscribed, but there's a series I did on my channel called the Versus series, and I see hundreds of people have done it before. I feel again, I'm biased. I made the video, but I did research that I feel like you'd appreciate, where I went through and I made it's almost like a March Madness. That's like the idea I had in my head. So I sorted every dividend paying stock in every sector from market cap, smallest to largest. And then what you had to do is the smallest market cap would verse the second smallest market cap. And the winner, and there was like, I think it was like 11 categories that I would look at. The winner would go on to verse the third smallest market cap. And I did that the whole way up. And at first I was going to do a video on I broke it down by not only sector, but also industry and sub-industry. That way you're quite literally competing against people that do exactly what you do. Yeah. And then once I got the sub-industries, for the industries, I would try to compare industries that were the closest together. Cause sometimes they're, it's a little bit of a stretch, but I did the best. And then that all went to okay, here's the leader in each sub-industry. Here's the leader in each industry. And I had those battle it out again, smallest to largest market cap. So there's a playlist on my channel that you can go back and watch. You'll see there's one or two videos that are individual companies for some sub-industry or something like that. It was getting no views for the amount of research it was taking me. And granted, my channel was a lot smaller then, but then I started just doing it for the sector. So you can see the best stock in the healthcare sector, energy sector, and that that for everything that we've talked about so far. I feel like you'd appreciate that the most. And it'd be really cool for you to go through those videos of best stock in the communication services sector, or the consumer staples, or whatever it might be.
Absolutely.
And look at when that video was released and look at it now. And I was going to do that too, of hey, it's been a year since I made this video. How's this stock done compared to the others in its sector? Just out of curiosity, I want to know that too. So, I mean, if you beat me to the research, definitely let me know. But it's just cool because that seems like how you like to have the diversification throughout each sector, and then you like to have the best of the best in the sector, which makes sense. So those were the stocks that, according to the numbers at the time I did the research.
It is not necessarily the best of the best. I want to add let me see. for instance, the UFPI, one of the industrials that I added, it was a relatively unknown to me until your video, and but I wouldn't exactly classify it as a industry leader or a big name because I'd never heard of it, but the fundamentals, the evaluation of the company just made sense, and it's in a place where I felt that in the long term it's going to be a profitable company for me to add to my portfolio. So that's why I added it. It's not necessarily the best of the best, but at this point in time, and based on its history and where things seem to be projecting, I felt like it was a good addition.
Yeah. I mean, I've had people suggest this to me, and you could do it yourself if you wanted to, where you make like a simple spreadsheet of like, you can even do like just 5 columns of like each of my Power 5 headers. And then like each week you just put like the leader of those. And it's almost like a big watch list where you're like, okay, all of these were on there. And like I said, sometimes there's going to be duplicates every quarter. That stock still stays on there, which to me is a good sign. So you can do that, and then like next time you're looking, like you can just literally write the company name, the ticker, and like the industry. And then that way you're like, okay, I'm looking for a stock that has really good 10-year returns and I want it in the financials industry. And then you can look back and like, oh, okay, Troy talked about this stock, 7 Power 5s ago, but now let me look into it and see. Because at the end of the day, like I said this thousands of times already, the Power 5, the list is generated by stocks that are going ex-dividend. But that's just because I needed a list that changed every week that I didn't have to think of. Like some people are like, oh, Troy's doing this, or Dividend Obsession's pushing like the dividend capture strategy. I mentioned 0 things. Like I don't care about that. Like, I just needed a new list. That's all I needed. So like I was like, okay, what with dividends changes every week? Oh, the stocks that are going to pay out every week changes like that.
Absolutely.
So I was like, okay, there you go. But so you could try something like that too. Like I said, this past Power 5 at the time of recording is the highest percentage off is a financial stock. So if you're looking at for a stock that is quality that just happens to be trading high, like I think that one's like 47 or 44% off of its 52-week high.
Right.
Like that could mean it's going downhill from here and don't buy it.
Right.
It could mean, hey, this stock supported a 52-week high and now it's down for whatever reason. Look into that, and if it's a justifiable reason, now you can buy in 47% cheaper.
Yep, absolutely.
So
it's not necessarily the best of the best. I'm just looking for good bargains that I can hold on for the long term.
Yeah, I like that. Okay, so I mean, you didn't say. So is your goal like long term? I know you said that you want to be able to pass it down and generational wealth and leave a legacy. Is your goal, say when you're 70 years old, to like be able to live off of this dividend income, or is this, or how do you plan on that?
Somewhat. I because of what I do and my passion and love for what I do, obviously I'm being compensated to do what I love to do, and it's how I earn a living. But at some point, I want to do it. And I think in one of your videos, you talked about doing it more passively, but just doing it not because I have to or need the money, but just doing it because I just love doing it.
Mm-hmm. Yeah. I mean, that's the way I want to get. Like, I want to get my portfolio. When I say I want to quote unquote retire early, it's not, oh, I'm making, $80,000 a year off of dividends. I'm just going to sit here and do what I don't know if Call of Duty is going to exist when I'm, when I'm 50 years old. But like, I don't want to just sit around the house. It's just at that point, I'm financially free, financially independent, to where if I want to, go to the park and there's kids playing basketball and I know some things about basketball and I want to help them, like, hey,
100%.
Like, instead of shooting fadeaway top of the break 3-pointers, like, why don't you work on how to make a layup? Like, which foot do you jump on? Like, and like, I don't care. Yeah, I don't care if it is paid. I don't care if it isn't paid. I don't care how much it pays because I don't need the money. I'm just doing it for the passion. So same thing for you. And that would be for most people who not necessarily hate their jobs, but like don't enjoy their jobs as much as you do. So like, that's why I was asking for you, like you're doing what you love to do and you're getting paid for it. So like you might not have a goal of wanting to retire. You might want to just do that until you can't walk no more.
What I literally do now, I want to do for the rest of my life.
Yeah, that's great that you found that.
And right now I do it 5 days a week. But moving forward, maybe I could, because I don't have to have to have the income. Maybe I can only do it twice a week, and
Mhm.
I can travel the rest of the time. You know
Yeah.
what I mean? So it opens up. It opens up. But I'm not going to stop doing it because I love what I do.
Yeah.
It just changes. It just changes the significance of it in my life.
Yeah. That's super cool. Like that's the place that everybody hopes to get to, is to the point where they don't have to worry about like when the end of the road is, not as far as like life, but as far as like their working life, just because like the end of the road, there's almost no way that the end of the road's better than the road.
Right.
So, and that's the way you are. It's like, okay, when you're going to the theme park and you're going down the highway, you're getting off the exit because you know the thing off the exit is better than the actual highway.
Absolutely.
Your highway is the theme park. Like that's
Yeah.
cool. So, okay. So, I mean, you kind of touched on a lot of the different, like as far as the diversification and the rules you use for your stocks. So I'm not going to dive into those again, unless there's something else that you have to mention. Okay. So next one, this is always a weird question to ask. I might end up getting rid of this question unless we can like figure out a better way to word it. But what I'm trying to get at is, are there any like things that you hear either about dividend stocks or about dividend investors specifically, or anything like that, like myths or misconceptions that you just like over time you figured out aren't true and you want to just like take time to debunk?
Well, I mean, I think most of the misconceptions are just geared towards dividend investing in general.
Mhm.
I think that it's the instant gratification versus delayed gratification thing. Most people are more interested in things that are going to benefit them right away in the near future, whereas dividend investing is not geared toward the right now. It's geared toward 5, 10, 15, 20 years down the road. So it's really trying to overcome the instant gratification that people seek out versus delayed gratification. Because one of the things that we talk about is most people don't want to get involved with dividend investing until they see somebody doing $500, $1,000 a month. You know what I mean? And but they don't realize that they've been doing this for 5 and 10 years, and that's what took them to get to that, $500 or $1,000. So it's the overcoming the stigma that dividend investing is not beneficial to the little guy or to anybody in general. Really.
Yeah, I don't think anybody said that before, and that's so true, because like you have the instant gratification of like regular stocks, which is your meme stocks, which is your crypto, which is your penny stock, stuff like that, where it's just like, okay, there's a chance that this $100 that I use to buy 1 billion shares of this penny stock actually does something and it turns into, 3 cents and now I'm rich, which most of the time won't happen. And then there's also the, like you have that part of the instant gratification, because if it does go up 100%, 200%, like it's way more likely that a penny stock does that than Apple. Apple's not going to go up 100%. Nvidia might, but Apple won't. But like, So you have stuff like that. And then you have the delayed gratification, which is dividend investing. But then I've noticed, and you spoke about this being your mistake that you made in the beginning and your lesson learned, is people try to merge the two. And I feel like that's where the high yield and stuff comes in. Where they're okay, I'm doing dividend investing, right? Like, look at me doing the good things over here, but you're still trying to get the instant gratification of a 55% yield. And like that's really, so as you were saying that, I was like, that's a different way to think about it. Like people are trying to cross the bridge to something that they know or they've heard is a good thing in dividend investing, but they're still addicted to that instant gratification, which is where the high yields come in.
Yes, absolutely. So it's just understanding that this, really investing in general is not as much about taking those high leverage risks as it is about being just consistent with what you do on a regular basis. Just staying consistent, because those high risks, they might have high rewards, but they also have the opposite side.
Big risk.
Opportunity
to lose all the money too.
So I want I want the stress-free aspect of investing, not trying to, manipulate and make these moves that's going to cause. I just want to kind of coast along.
Yeah. Well, and you'll like, whether it's on YouTube or Instagram or TikTok or whatever medium you find it on, like you always see like these reels or short videos or even YouTube videos where somebody's going to tell you, oh, I did this random thing and it made me all this money. They're not like, and it's the same thing with the predictions that you see on CNBC or whatever. Like you always hear about, Michael Burry predicting the housing market crash or whatever, but you never hear about the 1,000 predictions he made before that and the 1,000 he's made after that.
Right.
And it's the same thing with stock picks. It's like, okay, you might hear or watch this reel or whatever on TikTok that this one young kid bought this one EV company that nobody's ever heard of and he made 20,000% on it. But you didn't hear about the other 50 grand that he lost before that, or the margin he's still in, or whatever, all kinds of stuff, or the fact that he did this quick video and he still kept, like, the dude, I don't know if you're familiar with the Dogecoin guy. That was like the Dogecoin millionaire or whatever he was, made all this money, literally, like there's no premise to it, made it all, was still, hard-headed and stubborn, didn't want to sell it. Now he's like a regular dude again. He could have just sold the money, took it for beginner's luck or whatever happened.
Oh no, I didn't hear about that. He lost it all.
Yeah, well, Dogecoin went from whatever, almost $1 down to whatever it is. I don't even know what it is now, but like nobody, Elon Musk ain't talking about it, so I'm assuming it's not doing good. But so like, but he not only didn't sell or take money off the top or whatever, he kept adding to it as it was going up, and therefore his cost basis kept rising, because crypto is the same way. You have a cost basis, so like his cost basis kept rising, and now he's like underwater in it. So like, yeah, he might have I don't know, $300,000 as what his Dogecoin's worth, but he put 500 grand into it. So everybody sees that like, oh, this guy's got $300,000 worth of Dogecoin. Like, yeah, that's cool. Just like a lot of people with some of these stocks that are negative.
And volatility, man. Those stocks with that high volatility, man. I don't want to deal with that.
Yeah, that's the same thing. Like what comes up must come down. Like Alicia Keys said that, and a bunch of other people said that. It's one of those things where like, yeah, you have the chance to make 50%, but unless you're the guy that knew about it way before, which the odds are you aren't, because there's people that are out there that are smarter than you and have access to more information than you do. Literally, you might spend 10 hours a day, they spend 11, or there might be somebody that spends 11, they spend 20. Like somebody spends more time doing something than you do. So I don't know. It's what, everybody's attracted to exactly what you said. Instant gratification, making a bunch of money real quick off of all that. I know I have so many friends on Facebook that do the thing, and they're like, the thing that stinks about it is like, that's the thing that people are attracted to in the beginning. And then what happens is a lot of times they get burnt, and they don't think it was the strategy or the lack thereof.
Right.
They think it's investing. Investing's a scam. Dividends are a scam or whatever. And I'm just like, maybe it was your strategy or lack thereof that's the problem.
Yep.
Exactly. And that's because like, how many people do you know that are in their 50s or 60s that are like, oh, I tried it. Maybe they tried it during the housing market.
And that's I thought about that when I went through my little kerfuffle, I don't know what you want to call it, when I lost money in 21, 22, somewhere or that. But I'm of a different mindset in that I having the athletic background. One of the things that I've always kind of operated on is, if somebody has done it before, it can be done again. Mm-hmm. And so yes, I lost money, and it was frustrating and deflating. But I also understood that if somebody else has been successful in the stock market, all I need to do is make sure I continue educating myself to get better at the choices that I make, and then I can be successful too. So the losses didn't discourage me; they just encouraged me to educate myself more.
Yeah. Well, and the most important thing about that to understand about the stock market, and I said this in my last interview, is the stock market and investing isn't a either or. It's a and. So like, if you make money on Microsoft and I also have Microsoft, I can also make money on Microsoft. It's not like, we're both like, say you're the batting coach for the school that or the kids that you're teaching baseball. There's only one batting coach.
Right.
Like, if you were the batting coach, I can't be the batting coach. Like, that's just how that works. But if you make money on Microsoft, I can make money on Microsoft. So like, I see a lot of of bashing as far as like, this is a terrible investment or whatever, but like, there's no education on that. Like, why is it a bad investment? Or like at the end of the day, like this series, my conversation with you and the people before you and the people after you, the idea is that somebody will hear you talk and you specifically, they connect to your story and they're like, hey, this guy said that he chased yield. It didn't work. He had to start over. This is what he's doing. Like all those things. You spent money on that lesson, but somebody watching might get that lesson for free because they're not spending their money, they're spending yours.
Yep.
Which is great. And like same thing, I've made plenty of my own mistakes. And the cool thing about making the mistakes, and I've said this before, when you make the mistakes in the beginning, they don't cost as much. Now, relative to what you have, like if you only have $500 and you lose $500, that sucks.
Right.
But like if that's 100% loss, what if your portfolio is $500,000 and you make that same mistake that cost you all of your money? That's a way bigger difference. And I'd rather make that mistake with 500 than 500,000.
Absolutely.
So, we're killing segues today. So this last question for you.
Okay.
Someone is watching today and you did a great job of inspiring them to start dividend investing. So they're going to start investing and they're going to start dividend investing. They're going to do this on Monday. What is your suggestions other than to get started and other to do dividend investing? What's your best suggestion for them to set them on the road to success?
Just commit to your own strategy and don't let anybody else sway you from your strategy. Once you commit to your strategy, that's your strategy. And nobody's if you're comfortable with it, then whatever anybody else has as an opinion should not matter. As long as you're comfortable with what you're doing, stick with it. And if it's not working, it's not a failure. It's just time to re-examine what you're doing and just try to change course. But once you commit to your strategy is yours, and just own it and just ride with it.
Yep. Yeah, I like that. Yeah, the importance of figuring out a strategy. So importantly is identifying a strategy, because a lot of people don't even do that. That's step one that people don't even do. They're just like, oh, it's stocks, money, stuff. Like that's what they do. So strategy is important. Identifying your strategy to make sure that it's a strategy that you understand and a strategy that you can follow. Very important. And then, like you said, don't let people sway it, but it's very important to keep learning, because one thing I've noticed, and I'm sure you have too, is some of the things that you thought were well thought out when you first started, you look back on it a year later and you're like, that's really what I thought was a good idea. And like, that's not to say that you are dumb or you were dumb or whatever. That's just to say that you made that decision based on the knowledge that you had at the time. And the idea that you can now say that that was a bad idea or you shouldn't have done that and identify why it was a bad idea means you're growing and learning, which is
absolutely
the goal. So what you're saying about your strategy, like keep your strategy, stick to your strategy, identify a strategy, all those things, follow your strategy. More importantly, do that, but also keep learning. Don't just, come in an 18-year-old and say, oh, here's my strategy. I'm turning off Facebook. I'm not going to listen to any critiques. I'm not going to learn anything else, because you might not like what you see when you turn it back on in 4 years.
And good add to that, because we can't be rigid in everything that we do in life. We have to maintain some level of flexibility, because ultimately we don't have all the answers. And if we ever approach anything as if we have all the answers, that is the recipe for disaster.
Yeah. I like that. Yeah. I mean, it's as simple as like, here's my strategy, here's my goals, here's my timeline, because a lot of people don't factor that in as well, is the timeline part of things. Because if you it doesn't matter. Like, that's the thing that stinks about like YouTube demographics and stuff that I get, is they're like, okay, you get watched by 55% males that are between 23 and 34. I'm like, that tells me nothing. Like a 23 to 34-year-old could just be starting. They could have been investing for 10 years. I have no idea. So like, I can't like use that for anything. So identifying your timeline, which is one of the most important things next to your strategy, is like, okay, do you need the money tomorrow? If so, then maybe investing is not a good idea. Or maybe you need to do a way low risk investment that's more income based or whatever. Do you need the money in 40 years? Your investment style should look completely different.
Right.
So those are all very, very good points. Hopefully, somebody made it to this point in the video and they got that free advice. But yeah, so anyway, Mark, I wanted to say thank you so much for taking time out of your Saturday to speak with us.
I appreciate you having me, man.
I told you the time flies, doesn't it?
Yeah,
there it goes.
What is it, 11:49? Good Lord.
Well, hey, a little bit over an hour. Not too bad, though. So we're doing good. So I know earlier you said that you don't really have anything to plug, but if you have anything that you want to, any resources that you use, you want to tell people about, this is your chance to do so.
Nothing major. I mean, I use a lot of the same resources that a lot of people use. I've got a couple of apps that I use, and Seeking Alpha and FinViz is a place where I do a lot of research and. But other than that, I mean, just a lot of the things that I've accumulated over the years, last few years particularly, have come from my association with the Dividend Growth Investing Group, and a lot of the things that they share on there. And I've added a lot of resources and tools just being a member of that group. So I would encourage people to get in there and just learn as much as you can, because there's a lot of veteran and a lot of experienced dividend investors that you can learn a lot of stuff from.
Yeah, I second that. Yeah, so that's the Dividend Growth Investing Facebook group. It's got like the little, it's like a brownish color, like the Monopoly card as the profile picture or header or whatever it is. So definitely give them a follow. Yeah, Mark, again, thank you for your time, and we'll talk to you next time.
Yep, I appreciate it. Thanks.
And that concludes another insightful episode of Dividend Discussion. I hope you found inspiration and valuable takeaways from our engaging conversation. If you're hungry for more dividend investing wisdom, be sure to subscribe to Dividend Obsession and hit that notification bell to stay up to date with my latest interviews, tips, and strategies. Remember, the journey to financial independence is a marathon, not a sprint. Keep applying the lessons you've learned and stay committed to growing your wealth using dividends. Together, we can create a community of dividend investors sharing knowledge and supporting one another. If you enjoyed this episode, don't hesitate to share it with other investors that are equally passionate about the power of dividends. Let's spread our dividend obsession far and wide. But until next time,